Welcome to today's Explainer, where we're unpacking the absolutely fascinating dynamics of Allegiant Travel's recent acquisition of Sun Country Airlines. We've got a ton of really incredible data to get through, so let's just jump right in.
Okay, we're going to start things off with a massive puzzle. Just think about this for a second. How exactly does an airline manage to pull off record financial highs while at the exact same time grounding a huge chunk of its schedule? I mean, it sounds totally counterintuitive, right? But that's exactly what's happening here. And honestly, the mechanics behind it are pretty brilliant.
Section 1. A high-flying merger.
So, Allegiant Travel Company officially acquired Minnesota-based Sun Country Airlines on May 13, 2026. And you have to realize this isn't just your standard corporate buyout. They're basically creating this unique hybrid network. It's built on low-utilization passenger flights, which just means they only fly when demand is at its absolute peak. And they're pairing that with fixed-fee charters and a rapidly growing cargo business.
Section 2. Record revenues and margins.
Let's kick things off with the boom phase of this whole story. In the second quarter of 2026, the newly combined company pulled in a massive $943.5 million in total operating revenue. That is a nearly 37% jump year over year. We're talking almost $1 billion in a single quarter, mostly driven by bringing Sun Country into the fold.
And what this really highlights is their profitability. They didn't just boost the top-line numbers. Their adjusted diluted earnings per share literally skyrocketed 78% to $2.19. So they're taking all that new revenue and converting it into actual bottom-line value at a really staggering rate.
The big takeaway here is that they secured an industry-leading 9.2% operating margin for the third quarter in a row. Plus, standalone Allegiant saw a 40% yield increase, thanks to some pretty smart commercial initiatives we're going to talk about in a minute. And even in just that tiny window from the May 13th acquisition to June 30th, Sun Country managed to chip in $13.4 million in pre-tax income. I mean, the financial engine here is just roaring.
Section 3. The pilot attrition bottleneck.
But every boom has its friction, right? The core conflict here is super fascinating. CEO Greg Anderson came right out and said that junior Sun Country pilots are leaving at really elevated rates. And where are they going? Well, they're leaving for Delta Airlines, which happens to have its second largest hub right there in Minneapolis-St. Paul. So Sun Country isn't just competing for passengers in their own backyard. They're locked in this fierce battle for the actual pilots.
And here's the harsh reality of the airline business. You literally cannot fly planes without qualified pilots. It doesn't matter how high passenger demand is or how many planes you have sitting around. Because of this shortage, Sun Country had to slash its off-peak capacity, which led to an 8.5% reduction in total Minneapolis-St. Paul flying for 2026.
This bottleneck is hitting everyday Minnesota travelers pretty hard. We're talking fewer nonstop leisure options and way tighter schedules. If your flight gets canceled, there is significantly less wiggle room to rebook. Basically, if you're flying Sun Country out of MSP right now, you really need to keep a close eye on those departure times because the schedule is just so much thinner than it used to be.
Section 4. The strategic cargo pivot.
So you're probably wondering, how on earth is management navigating this massive operational headache while still raking in record profits? Well, they're making a huge strategic shift. It's an incredible juxtaposition. In Q1 2026, passenger departures for Sun Country were down 14%. But get this, cargo revenue shot up 64%. They're actively pulling capacity away from scheduled passenger service, which is getting hammered by the pilot shortage and volatile fuel costs, and they're pouring all those resources straight into cargo.
To really understand why they're doing this, you need to know about something called a fuel pass-through program. Cargo and charter flights operate on these fixed-fee contracts where the client, think Amazon for their cargo side, actually pays for the fuel. This creates an incredibly predictable revenue stream that completely shields the airline from inevitable spikes in energy prices.
This pivot is absolutely monumental for their long-term stability. Sun Country's cargo revenue hit an all-time record of $50.6 million in Q2. They've expanded their cargo fleet to 22 aircraft, and just look at the projections. They're expecting their cargo flying to grow by over 60% next year, while passenger flying continues to shrink. They are literally just following the safest, most predictable money.
Section 5. Upgrading the passenger experience.
Now, don't get me wrong, they definitely aren't abandoning their passengers. Actually, it's quite the opposite. They're heavily investing in high-margin upgrades for the flights that do take off.
To maximize that passenger revenue, they're partnering with Expedia for the very first time, which is already bringing in tons of new customers. They're also adding complimentary onboard beverages across the Allegiant brand to match Sun Country, because hey, everyone loves a free ginger ale at 30,000 feet. On top of that, they're aggressively pushing their co-branded credit card program, and bank compensation from that is already up 24%.
But their ultimate high-margin play is something called Allegiant First. This is a brand new premium seating tier debuting in spring 2027. And the genius of this is all in the layout. On their new MAX aircraft, they are only sacrificing 2 total seats from the main cabin to fit in 8 highly profitable premium seats. It is an absolute home run for their unit economics.
Section 6. Navigating the future. Merging 2 airlines is a massive, multi-year journey. They've already launched their new Expedia distribution channels, they're rolling out that premium seating next year, and the ultimate end goal is to secure a single operating certificate from the FAA by the first half of 2028. That's when they'll finally be able to operate as one unified powerhouse.
But what about that pilot bottleneck, right? Well, they're tackling it head-on with a staggering $275 million pilot retention bonus. And because their balance sheet is incredibly strong, they're sitting on $1.3 billion in available liquidity, they're funding this huge payout entirely in cash. And guess what? It's working. Their training classes for late 2026 are already completely booked up.
Looking ahead, their financial outlook is remarkably resilient. They're expecting $140 million in annual run rate synergies by 2029. They're taking delivery of 6 more of those super fuel-efficient 737 MAX aircraft by year-end. And honestly, the most impressive part? They are projecting a profitable third quarter even with overall capacity being cut by 5.5%.
So, I want to leave you with this final thought for today's explainer. As Allegiant and Sun Country essentially rewrite the entire leisure airline playbook, will this unique hybrid model, balancing high-yield premium passengers on one side with ultra-stable cargo operations on the other, become the new standard for surviving the airline industry's toughest bottlenecks? It is going to be absolutely fascinating to watch this unfold. Thanks so much for joining me today, and keep learning.